Ever wondered how to predict the stock market trends? Welcome to the world of stock market indicators, the tools that traders use to make sense of the complex financial markets. These indicators play a pivotal role in trading, helping to decipher patterns, predict future movements, and ultimately, guide investment decisions. Imagine trying to navigate a ship without a compass or a map. That's what trading without indicators is like. They act as your compass, pointing you in the direction of potentially profitable trades. Now let's briefly define some common terms in technical analysis. First off, trends. In the simplest terms, a trend is the general direction in which a security or market is moving. Bullish and bearish are terms used to describe upward and downward market trends respectively. So, buckle up as we embark on this journey to understand and use these market indicators. We'll delve into more detail in the following sections, so stay tuned. So, what are these indicators that traders swear by? Let's pull back the curtain and take a closer look. First off, we have moving averages. This indicator is a staple in the trading world. It's essentially the average price of a stock over a specific period. Whether you're looking at a 50-day or 200-day moving average, this tool can help you identify a stock's overall trend. Is it trending upward, downward, or moving sideways? The moving average will tell you. Next up, we have the Relative Strength Index, or RSI. This handy little tool measures the speed and change of price movements. It's like a stock market speedometer, giving you insights into whether a stock is overbought or oversold. If the RSI is over 70, the stock might be overbought and potentially due for a price drop. Conversely, if it's under 30, the stock could be oversold and might be gearing up for a price increase. Then we have the MACD, or Moving Average Convergence Divergence. This indicator helps traders identify potential buy and sell signals. It does this by comparing short-term and long-term price trends. When the MACD crosses above the signal line, it could be a good time to buy. When it crosses below, it might be a prime time to sell. Finally, let's talk about Bollinger Bands. These bands encapsulate the standard deviation of a stock's price, helping traders anticipate volatility. The wider the bands, the greater the volatility. Similarly, the narrower the bands, the lower the volatility. When a stock's price touches the upper band, it might be overbought. When it touches the lower band, it could be oversold. These indicators are not crystal balls, but they can provide valuable insights into the market's mood and potential price movements. It's like having a compass in the vast ocean of the stock market. Remember, these are just tools, not guarantees. They can help you make informed decisions, but they can't predict the future. Use them wisely, and they can be powerful allies in your trading journey. These indicators are the tools that can help you make informed trading decisions. Now that you know the tools, how do you use them to analyze market trends? Great question. Let's dive right in. Indicators are like the compass and map of a trader's journey. They guide you through the fluctuating landscapes of the stock market. But how exactly do you harness their power to spot trends and opportunities? Think about moving averages. This indicator smooths out price data to create a line that tracks the trend. When prices are rising over time, the line slopes upwards, and that's a bullish trend. Conversely, when prices fall over time, the line slopes downwards, indicating a bearish trend. Simple, isn't it? Then there's the Relative Strength Index, or RSI. This useful oscillator moves between 0 and 100, indicating overbought and oversold conditions. If RSI exceeds 70, the market might be overbought and a downturn could be on the horizon. If it dips below 30, the market might be oversold, and an upward correction could be imminent. The MACD, or Moving Average Convergence Divergence, is another handy tool. When the MACD line crosses above the signal line, it could be a good time to buy. When it crosses below, it might be time to sell. And let's not forget Bollinger Bands. When the prices touch the upper band, the market could be overbought. When they touch the lower band, the market could be oversold. But here's the key. Don't rely on just one indicator. Each one provides a piece of the puzzle. Combining them helps you see the complete picture. For example, if the moving averages indicate a bullish trend, but the RSI suggests the market is overbought, you might want to hold off on buying. Remember, using a combination of indicators can give you a more accurate reading of market conditions. So, keep exploring, keep learning, and let the power of indicators guide your trading journey. Let's put these indicators to the test with some real-world examples. Picture this. We're in the middle of a bull market, and the share price of a certain tech company has been steadily climbing. A trader who's been following the stock notices that the Relative Strength Index, or RSI, has crossed above 70. This suggests that the stock is overbought and could be due for a correction. Acting on this signal, the trader sells his shares, avoiding the subsequent dip in the price. Now let's consider a scenario where a trader is eyeing a potential investment in a manufacturing company. The stock has been on a downward trend, but the Moving Average Convergence Divergence, or MACD, has just performed a bullish crossover, indicating that the trend may be about to reverse. The trader decides to buy the stock, and sure enough, it starts to rally in the coming weeks. These examples illustrate how indicators can be used to inform trading decisions. But it's important to remember that no indicator is infallible. They're tools to aid in analysis, not crystal balls that predict the future. The key is to use them in conjunction with other forms of analysis to make well-informed decisions. Let's consider one more example. A trader notices that the Bollinger Bands on a particular stock are narrowing, indicating decreased volatility. This could suggest that a significant price movement is on the horizon. But rather than jumping to conclusions, the trader also checks the volume of trades. The volume is low, suggesting that the market isn't strongly backing this potential price movement. By combining these two indicators, the trader is able to make a more informed decision and avoid a potentially risky trade. These examples show that indicators, when used correctly, can provide valuable insights into the market. Remember, the key to successful trading isn't just about having the right tools, but knowing how to use them. But beware, there are common pitfalls that traders often fall into. When it comes to stock market indicators, understanding their purpose and functionality isn't enough. It's equally crucial to be aware of the common mistakes and misinterpretations that can lead to faulty trading decisions. One of the most common errors is relying solely on a single indicator. It's like trying to predict the weather by only looking at the wind direction. Sure, it gives you some information, but it's not the whole picture. Each indicator offers a unique perspective, and it's the combination of these perspectives that provides a more accurate analysis. Another frequent misstep is overlooking the market context. Indicators aren't standalone tools, they need to be interpreted within the broader context of market conditions. Misreading the market context can result in misinterpretations of what the indicators are signaling. A third common mistake is expecting infallibility from indicators. No indicator is a crystal ball. They are tools designed to help you gauge probabilities, not certainties. Expecting them to always point to winning trades is unrealistic and can lead to disappointment. Lastly, many traders fall into the trap of indicator redundancy. Using multiple indicators that measure the same thing can lead to overemphasis on a particular aspect of the market, skewing your analysis. Avoiding these mistakes can significantly improve your trading strategy. So, remember to diversify your indicators, consider the market context, accept the inherent uncertainty of trading, and avoid redundant tools. With these in mind, you're on your way to more effective market analysis. For those of you who are more experienced, we have some advanced tips. You've mastered the basics of stock market indicators, but the real game begins when you start combining technical analysis with fundamental analysis. This is where you blend art with science, intuition with data. Technical analysis, as you know, involves interpreting market trends using indicators like moving averages, RSI, MACD, and Bollinger Bands. It's about patterns and trends, the heartbeat of the market captured in lines and graphs. On the other hand, fundamental analysis is about the health of the company behind the stock. It involves poring over earnings reports, understanding industry trends, and getting to grips with economic factors. It's about knowing the company like you know a close friend. When you combine these two, you get a holistic view of the market. You'll see the forest and the trees. The technical analysis provides the when of the trade, while the fundamental analysis provides the why. It's like having a compass and a map in the wilderness of the stock market. But remember, this strategy requires practice. It's a bit like learning to play a musical instrument. At first you might hit some wrong notes, but over time you'll start to hear the symphony. Mastering these advanced strategies can give you an edge in the market.